Hello, 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 all my dear students of Full English. Are we live? Hello, all my dear students of CA Final Full English. I hope you are doing good. I hope your studies are going on great for your upcoming exams of May 26, September 26, or Jan 27. So today we are going to start with the revision video of taxation of trust for your CA Final Direct Tax. So let us start with the discussion of taxation of trust, and along with the taxation of trust, we will also be doing the discussion of exit tax in this particular video. Now, for the purpose of income tax law, all the trusts are divided into two categories. You can say regime 1 and regime 2. Regime 1 covers certain institutions, associations which are covered under 1023C, etc. And regime 2 are trusts which are covered under 12AA earlier and now under 12AB after 2021. So all the trusts are categorized into two parts. Regime 1, regime 2. Regime 1 are certain institutions which are covered in 1023C. And regime 2 are certain charitable and religious trusts which are covered under 12AB. Now, what is more important for us? For us, more important is regime 2 because regime 1 is now expired. Regime 1 is expired from 1st of October 2024 and regime 1 is now into transition phase. Regime 1 is now partially expired, completely it will be expired in next few years, but regime 2 is the future. So your entire chapter will be discussed from the perspective of regime 2 only, even though regime 1 and regime 2 are exactly similar. There is no difference in the taxability of regime 1 and regime 2, which I have told you in the class. Exactly, it is similar only. There is no difference. So entire discussion we are going to do from the perspective of regime 2 only. Wherever a specific discussion on regime 1 is there, I will speak about it. Now, the very first thing that we need to understand over here is, if you want to be covered in this chapter, you need to be doing either a charitable activity or a religious activity. Therefore, these two terms are very important for us. What do you mean by the term charitable purpose and what do you mean by the term religious purpose? Unfortunately, the word religious purpose is not defined under the income tax law. But yes, the word charitable purpose is defined under income tax law in an inclusive manner. Religious purpose is not defined. So how to understand the term religious purpose in common parlance? In common language, you need to understand the meaning of the term religious purpose. What about charitable purpose? For charitable purpose, there is a specific definition given under section 2, clause 15, which includes 6 specific points and 1 general point. There are 6 specific items in the definition of charitable purpose and 1 general point in the definition of charitable purpose. What are the 6 specific points, sir? The 6 specific points are as follows. Charitable purpose includes relief of poor. Second, education. Third, medical relief. Fourth, services in relation to yoga. 5, preservation of environment. 6th, preservation of historical monuments. These 6 items, if you do, they are always considered to be a charitable activity. These purposes are always considered as charitable purpose. Now, the 7th item comes with a condition, that is a monetary condition. The 7th item says that any other object of advancement of general public utility can also be called as charitable purpose if the commercial receipt is up to 20% of total receipts. So for the 7th item, you have to check your commercial receipt and total receipt, and your commercial receipt should be up to 20% of total receipts. If the commercial receipt is up to 20% of total receipt, you will get the relaxation. Sir, what do you mean by commercial receipt? Commercial receipt means nothing but the fees which you charge, the revenue which you charge to your consumers. That is your commercial receipts. And denominator, you take total receipts. Take fees also, take donations also, etc. everything. And then compare whether it is coming up to 20% or not. If it is coming to 20%, then great. You can call yourself as a charitable purpose. But for the first 6 points, there is no condition. There is no restriction. There is no monetary condition applicable for the first 6 points. The monetary condition is only applicable for the 7th point. I hope it is clear to all of you. Now, there is a very recent Supreme Court judgment of Ahmedabad Urban Development Authority, Supreme Court 2022 judgment on this issue only. When can an activity be considered as trade, commerce or business for the purpose of attracting the provisions of proviso to 215? Now, the 7th category is given under proviso to section 215. The first 6 points are given in first 6 points, first 6 subsections, and the 7th one is given as a proviso to the section. So whether I am doing whatever activity I am doing, whether it can be called as a business activity, commercial activity, trade activity or not for the purpose of this chapter, how to determine that? So the court has not given any clear judgment. The court has said that we are neither precluding assessee to claim any benefits, nor we are stopping the authorities to deny exemption. We are not saying whether the assessee is correct or the department is correct. We are not saying the assessee you don't claim exemption, neither we are saying the department that you don't disallow the exemption. Both have the absolute right. You have to look into the facts and circumstance of every case. You have to look into the facts and circumstance of every case and determine. You have to scrutinize the books of accounts of the assessee. You have to scrutinize the records of the assessee of every year and identify whether the assessee is actually doing trading activity or not. And then identify whether it is crossing the limit or not of 20%. So what is trade, what is commerce, what is business? It all depends upon facts to facts. Department has absolute power to disallow. Assessee has absolute power to claim exemption. Both have to sit together, identify the facts and circumstances of every case, and then determine whether the activity which is done by the assessee is a charitable activity or not. I hope it is clear to all of you. Now, we are coming to the most important part. The next 2-3 pages are the most important part and the most complicated part of this chapter. The very first thing that we need to understand over here is how a trust will compute its income. See, the computation of mechanism of the trust is absolutely different from any other person. All other persons under the income tax law has to follow 5 heads of income. But the trust will never follow 5 heads of income. The computation mechanism of the trust will be as per this only what you are seeing on the board. That is, first of all, the trust will write down. Suppose this is a school. Let's take an example that this is a school. It's a school. Okay. Let's understand from the perspective of a school. So the very first thing that they will write over here is the income from the trust. Whatever income they have earned from the trust, that they will write over there. What do you mean by income from trust? All kind of incomes. Profit from school will come here. Rental income will come here. Interest income will come here. Property income will come here. Every income will be income from trust. No need to bifurcate into 5 heads of income. All income of the trust is income from trust only. You have to write everything over here. After that, you get donations from various parties. So what is the treatment of donation? Let's talk about the treatment of donation now. How donations are treated under income tax law. Let's talk about that. Donations can be of 2 types, where the identity of the donor is known and the identity of the donor is unknown. If the identity of donor is known, the donor is saying the name and giving it. Donor is not willing to hide his name. Donor is saying the name and giving the donation. In that also there are 2 types of donation. Where identity is known, in that also there are 2 types of donation. First is called as where the donation is given with a specific purpose. That is known as corpus donation. Corpus donation is not an income subject to some conditions. Which are those conditions? Dangerous conditions are there. I will come to that in a while. Second, a donation which is voluntarily given without any corpus, without any specific purpose, that is considered as an income, add to income statement. So, a donation which is given with a specific purpose is a corpus donation. It is exempt subject to some conditions. Conditions we will see. And the donation which is voluntarily given, that is taxable. You have to add to the income statement. What about the identity is not known? That is known as anonymous donation. That is taxable at 30% under 115 BBC. We will see that later on. So, you have to divide all the donations into 2 categories. Where identity is known, identity is unknown. Where identity is known, in that there are 2 categories. Corpus and voluntary. Voluntary donation add to income statement. Corpus donation exempt subject to some conditions. Okay. Now, what are the conditions subject to which corpus donations are exempt? I am coming to that in a while. Before that, I am coming back to the statement. So, the very first thing in the statement will be income from the trust. Second, voluntary donation always taxable, add to the income statement, and corpus donation also taxable if not exempt. Corpus donation is not always taxable. Sometimes it is taxable, sometimes it is exempt. When it is exempt, that we don't know as of now. After that, that is your total income. From that, you have to reduce first 15% ad hoc exemption. 15% flat exemption you will get. No condition to fulfill, nothing. Just you have to invest this money in the mode specified in 11.5. That's it. You have to keep this money in the mode specified in 11.5. You cannot keep it in private company shares, etc. You cannot do all those things. Invest in the mode specified in 11.5. You will get the exemption. That's it. After that, whatever money is left, you apply the money for charitable and religious purpose. You apply the money for charitable and religious purpose, but the deduction will only be allowed on paid basis, will not be allowed on accrual basis. To trust, deductions are not allowed on accrual basis. To trust, deductions are only allowed on paid basis. That too, if the application is more than 10,000 rupees, you have to make the payment by account pay check, account pay draft, ECS or such other electronic mode. Plus, if the application is given to residents, you have to also deduct TDS. Otherwise, Section 40, Clause A, Subclause 1A, 30% of the application, that is 30% of the expenditure will be disallowed. So, with this application comes 3 points. First, the application is allowed on payment basis. Second, it is allowed if it is more than 10,000, if it has to be paid by 4 modes. And third, if it is paid to resident, you have to deduct TDS. I'll show all these points where it is written. I'm consolidating all of them at one place only. Now, what do I mean by application for charitable and religious purpose? The word application is very wider as compared to the word expense. There are a lot of things which can come over here. There is no exhaustive list given by anybody. The income tax law does not define the word application for charitable and religious purpose. You need to understand based on the practical scenarios. Like, I have put some examples over here. When you give a loan, when you take a loan for some items, for the purpose of the trust, you are taking a loan. Now you are repaying the loan. That repayment of loan can also be considered as what? Application. Suppose you are purchasing some fixed asset. That fixed assets can also be purchased. You are purchasing some laboratory equipment for the students. You are purchasing some land for the students so that they can make a playground over there. That can also be considered as an application. But then, once you consider a fixed asset as an application, then you cannot claim depreciation on that fixed asset as per Section 11, subsection 6. Then, payment of income tax is also considered as an application. This is an only exception under the entire income tax law where you are getting the benefit of income tax also as a deduction. Then, giving education loan to the students can also amount to application of income. You are giving loan to education loan to your students of the trust. Some needy students are coming, you are giving loans to them. That is the objective of the trust, to give loans to needy students. That can also be considered as an application for religious and charitable purpose. There is no exhaustive list for it. So, how will you go with the statement? With the statement, you will go first, write down all the incomes, minus, then you will add voluntary donation, plus corpus donation if exempt. Then you will add what? Then you will reduce 15% flat exemption. And then you will reduce your application for charitable and religious purpose. Now we will talk about when corpus donation is exempt and when it is not exempt. Let's try to understand this dangerous point. See, the corpus donation point you need to understand in 3 steps. This amendment came in Finance Act 2021. Before Finance Act 2021, what used to happen? Till 31st March 2021, corpus donation was blindly exempt. If I receive any, before 21, I am talking about prior to 21. Prior to 21, whenever I used to receive any corpus donation, 1 crore, 2 crore, 10 crore, 50 crore, 100 crore, 5,000 crore, 10,000 crore, whatever corpus donation I received before 2021, it was blindly exempt. Blindly, no tax. But after 2021, from 1st April 2021, they brought a dangerous amendment which is divided in 3 steps. Step number 1. Suppose in the current year, 25-26, I received 10 crore as a corpus donation. Now it is not blindly exempt. Earlier it was blindly exempt. Now it is divided into 3 steps. Suppose in the current year 25-26, I received 10 crore as a corpus donation. Now this 10 crore will be exempt if you invest this corpus donation in the mode specified in 11 subsection 5. That is mainly government securities and immovable properties, and certain securities are there which I will show you in a while. So what is the first step? I received 10 crore as a corpus donation in 25-26. I want to make it exempt. I have to invest that in the mode specified in 11.5. So suppose I received it and I invested that in the mode specified in 11.5, then it is exempt. If I invest in other than 11.5, then this 10 crore will be taxable. This is first step. Let's be positive in life. We received 10 crore, we invested in the mode specified in 11.5. Therefore, this 10 crore is exempt in 25-26. Now next year, this donation has come with a specific direction. It has come with a specific purpose because it is a corpus donation. Next year in 26-27, you withdraw 10 crore and you apply that money for objects of the trust, then that application will not be considered as an application. You will not get the deduction. So next year, when you withdraw that money from the corpus and you withdraw that money and then you apply for the purpose of the trust, then that is not considered as an application for the purpose of trust. Now next year, 27-28, third year, I might have earned 50 crore rupees income in the third year. From that 50 crore, if I redeposit back, say 7 crore rupees again to 11.5 modes, 50 crore I have earned from some other sources, okay, from the fees from the students or some other sources I have earned, rental income, whatever it is. From that I have again reinvested where? Again I have redeposited back in the 11.5 modes. So to the extent I have redeposited back in the 11.5 modes, that much I will get exempt. That much I will get exempt. So the rule is very simple. At step 2, when you incur the expense, you don't get the deduction. But at step 3, when you redeposit the amount, at that time you get the deduction. Please comment and explain whether you understood or not. I have given you a big example on this. So step 1, you receive the corpus donation. It will become exempt provided you invest. Step 2, you withdraw and you apply. Don't consider as an application. Step 3, when you deposit back, then it is considered as an application. I hope it is clear to all of you. Now, this 3-step directions have come after 2021. Before that, it was directly exempt. Okay. Now, in this also, there is a catch. In this also, there is a catch. The deposit back should happen within 5 years. So, if you deposit back after 5 years, then it is not allowed as an application. Where it is written, sir? It is written here in point number 2. The deposit back should also happen within how much year? Within 5 years. I hope it is clear to all of you. Now, there is one more thing which should happen within 5 years. And that is, now this is an absolutely different discussion. It has nothing to do with corpus donation. Suppose I took a loan of 10 crore and I purchased a building. Here also after 2021. After 2021, it is not allowed as an application. If you take a loan and apply the money, that is not allowed as an application. You have to apply from your pocket. Then only we will allow you that as an application. So if you take a loan and apply, not allowed as an application. Yes, but when you repay the loan, at that time it will be allowed as an application. So now the question is, I took a loan of 10 crore. I purchased a building, not allowed as an application. After that, I repaid the loan of 10 crore. Then that time it will be allowed as deduction. In this also there is a catch that you have to repay the loan also within 5 years. So in case of corpus donation, you have to deposit back within 5 years. And in case of loan, you have to repay within 5 years. Then only it will be allowed as an exemption. I hope it is clear to all of you. Is this clear? So these are the 2 points which are mentioned over here. One is mentioned over here. And one is mentioned over here. Okay. Now, regarding this deposit back and regarding this repayment of loan, this is only applicable if it is after 2021. If it is an item prior to 2021, then deposit back will not be allowed as an application, and repayment of loan will also not be allowed as an application. Logical. I'll explain you why. If these activities has happened after 2021, then deposit back will be allowed as an application if you deposit back within 5 years. Then repayment of loan will be allowed as an application if you repay within 5 years. Suppose, for example, you have taken a loan in 2018 of 10 crore and in 2019 you have purchased the building. At that time, taking a loan and purchasing a building is allowed as an application. At that time, it was allowed as an application. Now, if you repay that loan after 21, you cannot claim double benefit now. Correct? Because before 2021, if you take a loan and apply the money, it was allowed as an application. So on repayment, you should not get the deduction. So if you have done the activity before 21 and you are repaying and depositing after 21, listen, if you have done the activity, if you have done that activity of what? Activity of taking the corpus donation, activity of taking the loan and applying the money before 21, but repayment is done after 21 or depositing back is done after 21, then it will not be allowed as an application. This is a very important point which ICAI has put in the MCQ of CA final for May 26, September 26 and Jan 27. I have also explained that in the MCQ video also. I will also be putting the MCQ video for you all in full English, don't worry. Now, apart from this, a trust has to fulfill a lot of other conditions. Condition number 1, if they want to claim exemption, they have to fulfill a lot of other conditions, like the application should not be in the form of corpus donation to another trust. We will talk about this in a while. The trust should deduct TDS. The trust should not pay more than 10,000 rupees other than 4 modes. Okay. Next one, I will explain you. Excess application is not allowed. What do you mean by excess application? Suppose in 25-26, my income is 1 crore. I applied out of 1 crore, 15% will be exempt. Therefore, net income is 85 lakhs. Out of 85 lakhs, I applied 90 lakhs. So, therefore, there is a loss of 5 lakhs. Can I carry forward that loss? The answer is no. You cannot carry forward that loss. That is written in point number 4. Check it, please. For trust, excess application is not allowed to carry forward and set off. That is lapsed. For trust, excess application is not allowed to carry forward and set off. That is lapsed only. Next one. For trust, the deduction is allowed only if it is actually paid. That I have told you earlier also, that you have to pay and then you have to take the deduction. The trust should not directly or indirectly provide any benefit to any person specified in section 13. That we will see after some time. The trust should apply in India only, except with the approval of board. By default, the trust should apply the money in India only. The trust charitable trust chapter has made for the benefits of the Indian people, not for foreign people. But in some exceptional cases where the CBDT allows, then you can apply outside India also. So these are the few things that you have to keep it in mind. Okay. What all things you have to keep it in mind? Some of the things which I'll be again repeating. What all things I have already explained, that I will tell you. TDS you have to deduct. 10,000 rupees. If you make a payment more than 10,000 other than 4 modes, then expenditure will not be allowed. Excess application will not be allowed. That is repeated at 2 places. The expenditure will be allowed on paid basis. This first point I will explain in a while. This sixth point also I will come when I will teach section 13. And the expenditure should be incurred in India except with the approval of the board. If the board approves, then you can also invest outside India. Now, coming back to this statement. Sir, there is 10 lakh rupees still left here. Sir, how can we reduce this 10 lakh to 0, sir? There are 4 different ways in which you can reduce it to 0. There are 4 tax planning measures that I have identified under the income tax law. One by one, I am saying all of them. First one. If you are not able to apply the money for the objects of your trust, you can give donation to another trust. You can give that money as a donation to another trust and claim that as an exemption. So what are the conditions for that? First of all, the other trust, the donee trust and the donor trust, both should be registered under 12AA, 12AB or 1023C. Both should be registered trust under regime 1 or regime 2 as the case may be. Second, the donation which you are giving should not be in the form of corpus donation. Corpus donations not allowed as deduction. Corpus donations not allowed as deduction. Only voluntary donations allowed as deduction. Condition number 2. Third, corpus donation not allowed, only voluntary donation. That is the reason it was written over here. It was written over here also. The donation should not be in the form of corpus donation to another trust. This point was talking about this issue only. This issue which is mentioned in point number 2 over here. Point number B over here. The donation should not be in the form of corpus donation. It should be in the form of voluntary donation. That too. The voluntary donation should also be allowed in the form of only 85%. So first of all, corpus donation not allowed. Voluntary donation also allowed to the extent of 85% only. Suppose I donated 1 lakh rupees as voluntary donation, I will get deduction of only 85,000 rupees. 1 crore, only 85 lakhs. 100 crore, only 85 crore. I will not get more than 85%. Plus, suppose my total income is 100 crore. Out of that, 15% is what? Exempt. By default exempt. 85 crore is pending. Now, for example, pay attention please. To claim 85 crore deduction, how much I have to donate? I have to donate entire 100 crore. If I donate 100 crore, then I get 85 crore as deduction. Okay. In that case, this 15% which you are claiming, now you need not invest in 11.5. That is okay. Because you are already giving this entire money as donation. See, to claim 85 crore, you have to give 100. Now, if you give entire 100 crore, how will you invest this 15% in what? 11.5 mode. You don't have money only because entire money is given in the form of donation. So this 15% need not be, in case of donation, this 15% need not be invested in 11.5 modes. I hope it is clear to all of you. Now, the second case is a very genuine case. I am not able to apply this money. How much money is left for you, sir? In my example, the money which is left over here is 10 lakh rupees. I am not able to apply this money because I have not received this money. Then what should I do? In the current year 25-26, I have not received the money. That is the reason I am not able to apply this money. What should I do, sir? In that case, you go to the assessing officer, make an application 2 months prior to the due date of filing of return. So 2 months prior to the due date of filing of return, make an application to the assessing officer and tell that, sir, I want the exemption because I have not received the money. So how will I apply? So you will get the exemption in the current year. In the current year, claim the exemption without applying. Without applying, claim the exemption because you have not received the money. But in future, you have to do one thing. Whenever it will be received, you have to apply in that year or in the year following the receipt. Suppose you receive in 28-29, then you have to apply in 28-29 or 29-30. Otherwise, it will become deemed income of 29-30. Deemed income of which year? Deemed income of 29-30. I hope it is clear to all of you. So, if you have not received the money, you can make an application 2 months prior to the due date of filing of return. The assessing officer will give you exemption without applying today. But whenever you will receive, you have to apply in that year or you will get 1 year extra grace or year following the receipt, you can claim exemption. And if you don't apply till that year, then it will be added to your income and it will be added below 15%. From that, again, you are not going to get 15% exemption. I hope it is clear to all of you. Third case is also a very genuine case. I am not applying in the current year because I want to accumulate the money for specified purpose. I do not wish to apply in the current year because I want to accumulate for specified purpose. So you have to fulfill the conditions mentioned in section 11 subsection 2. What should I do, sir? Again, you should go to the assessing officer and fill a prescribed form. Form number 10. Which form? Form number 10 you have to fill with assessing officer. In the form, again you have to go 2 months prior to the due date of filing of return. In the form, you have to mention the purpose, you have to mention the period of accumulation cannot be more than 5 years. Plus, you have to invest that money in the mode specified in 11.5. You have to fulfill all these conditions. Go to assessing officer, fill the form, mention the purpose, mention the period cannot be more than 5 years, and you have to go to the assessing officer at least 2 months prior to the due date of filing of return, and you have to invest that money in the mode specified in 11.5. If you do all these conditions, then you will get the exemption in the current year. You can withdraw the money in future years and apply. Now, in some cases, it will be deemed income. Which all these cases? If the amount is withdrawn and not used for specified purpose, deemed income. Along with that, section 115 BBI will also apply, and directly 30% will apply to you. Later on, we will interlink that with 115 BBI. If you violate section 11 subsection 2, then 115 BBI will attract, and directly 30% will attract in all these cases without any deduction of any allowances or expenses. Nothing will be allowed to you. Directly 30% tax will be applied on you. Okay, now if you withdraw the money and donate it to another trust, not allowed. Donation not allowed. You cannot donate to another person now. You have to use it for specified purpose. You have given a promise that you will use it for specified purpose in form 10. So now you cannot donate. Next, if you withdraw the money and invest in some other modes other than 11.5, deemed income. Deemed income. Next, if you don't withdraw the money and use within 5 years, it will become deemed income of the 5th year. Not using the money within 5 years is also violation of the provision. So if you don't withdraw the money within 5 years and use it for the objects of the trust, you use it for the purpose for which it is specified, then it will become deemed income of the 5th year. I hope it is clear to all of you. Sir, is there any relaxation if the circumstances were beyond? I was not able to apply beyond circumstances. Some COVID has come, some calamities has happened. Then in that case, you can make an application to the AO and tell the AO that it was beyond my control to apply such purpose for the accumulated income for such purpose in India. So please give me relaxation. Then you can apply for some other purpose. But in that case also donation to another trust is not allowed. You can apply for some other purpose of the trust, but not to give as a donation. You cannot give that as a donation also in that case. So in all these 4 cases, 115 BBI is also attracted. So be careful with this. Okay. You can write it down over here also if you want. Now last reason, any other reason. Any other reason means any other reason means any other reason. Any damn reason you give, it should be logical, but any logical reason you give, you will get a grace of 1 year. Current year claim exemption, next year apply. If you don't apply in next year, then it will be deemed income of next year. This is 25-26. You have an income of 10 lakh. Take a grace of 1 year. Current year 10 lakh exempt, but next year you have to apply 10 lakh. But if you don't apply next year 10 lakh, then 10 lakh will be deemed income. Again, it will be added below 15%, not before 15%. I hope it is clear to all of you. So these are the reasons, these are the ways in which you can save your tax. Honestly speaking, these are not revision videos. These are exclusively explanations only. In revision video, I just don't take the pen and underline and read. I don't do that. I don't have a habit of reading the things in revision video. I explain each and everything in revision video. So that's the reason my revision video might be slightly lengthier, but it is very comprehensive in nature. Okay. Now, let's go to next section, section 11, subsection 7. What is this? This section says very simple things. That if you are registered as a charitable trust under 12AB, then you can either claim 12AB or you can claim 1023C, section 10 exemption. You cannot claim both of them together. A trust cannot claim 12AB also and 10 also. A trust cannot claim section 10 exemptions also and section 12AB exemptions also, not possible. But only one exemption is allowed to trust, and that is section 10(1) along with 12AB. Along with 12AB, you can claim only one exemption, that is section 10(1), that is agriculture exemption. That you can claim. Apart from that, all other exemptions, if you want to claim 12AB also and 1023C also, then you have to forego one of them. If you are claiming 12AB, then you have to forego 1023C. If you want to claim 1023C, then you have to forego 12AB. You cannot claim both of them together. That's what it is written. Only section 10(1) is allowed with both. Along with 12AB, you can claim section 10(1) agriculture income also, because on agriculture income, the central government does not have the power to impose tax. They cannot impose tax. Central government does not have the power in the constitution to impose taxes on the agriculture income. I hope it is clear to all of you. So nothing great as such. Now we will move on to certain procedure now. Procedure given under 12AB. How a trust will apply for registration? What are the different cases? When to apply? What are the time limits for registration? For how many years the application will be applied? Valid, from which year exemption will be available. Let's start with the first one. Who is the first category? The first category is all the existing trusts which are registered on or before 31st March 2021. So all those trusts which are registered before 2021, since 1961 till 2021, all those who have registered under the provisions of 12AA, they have to get themselves re-registered under the new provision of tax trust law, under the new provision of trust law under 12AB. Everybody has to get re-registered. By which date, sir? What is the date of application? They have to make an application on or before 30th June. By when the registration will be granted? The registration will be granted 3 months from the end of the month in which the application is uploaded. So whenever is the application uploaded, suppose the application is uploaded exactly on 30th June 2024, so count 3 months from the end of 30th June, that is 30th September. Then, from which year exemption will be available? Exemption will be available from earlier year only when the exemption was, when the registration was granted. For how many years the exemption will be? The registration will be applicable. The registration will be applicable for 5 years without inquiry. Why without inquiry? Because you are already doing a charitable activity. You are not a new trust. So why will we make inquiry for you? Already you have been granted a registration under old law. Therefore, there is no need to give another inquiry. I hope it is clear to all of you. Second, so what was the first trust? What was the first case? The first case was existing trusts which are already registered. They have to get re-registered by 30th June 2024. They have to make an application, and accordingly they will get a new registration form. Okay, new registration certificate. Second case, a new trust is that. New trust. They are making a fresh registration and they have not conducted any activity so far. So this is the previous year 25-26 is the first year of activity, and previous year 25-26 is the first year of application also. So they have not done any activity. So they are now first making the application, then they will start with the activity. There can be two types of new trust. One, which has already been doing activity, now making an application. Second, which has never done any activity and they are making an application. So this is the second case. They have never conducted any activity. So by when they have to make an application? They have to make an application 1 month prior to the commencement of the PY relevant to the AY from which the registration is sought. Suppose I want to start my activity in 25-26 previous year. So I have to make an application 1 month before that. So I have to make an application by 20th February. So I have to start my application by previous or 25-26. I want to start my charitable activity. I want to start my charitable activity in previous year 25-26. So I have to make 1 month prior to the beginning of the year. So I have to make an application by 28th of April 2025. 28th of February 2025. Then I will get registration within 1 month. That is by 31st of March 2025. I will get registration, and from 1st April I can start my activities. Then I will get the exemption from immediately next year, that is 25-26. But in this case, this is the only case where I will not get final registration. I will get a provisional registration for first 3 years. 3 years I will get provisional registration. Final registration I will get later. And this will be without inquiries. Without inquiries. No inquiry will be done here also. Because the activity is not started. What they will inquire? They will inquire after the provisional registration is expired. At that time, they will inquire whether I have done the things properly or not. As of now, no inquiry. I hope it is clear to all of you. Now coming to one more trust. Coming to the notes below. Now there can be another trust who has already commenced activity and has not availed exemption in previous year. So my trust is 10-year-old, but we have already commenced activity 10 years back. But we have not made an application. Now we are making an application for the first time. Activity commenced 10 years back. We are doing charitable activities since last 10 years, but we were not aware of the provisions of the income tax law. So we are making an application in the current year. So whenever you are making an application, now you can directly make an application. No need to make any provisional registration over here. Okay? No need to make any provisional registration. Directly make an application. It can, at any time after the commencement of activity, directly make an application for final registration. Provisional registration is not required here. Direct final registration is required in this case. So this is applicable for trusts which has not commenced activity are not required to get provisional registration. The principal commissioner or commissioner can grant approval within 6 months from the end of the month in which the application is received. Okay? And then you will be given the registration for 5 years. I hope it is clear to all of you, both the cases. Now coming to the third case. A trust which is provisionally registered. They have to come again after 2.5 years, because after 3 years the provisional registration will expire. So the moment provisional registration will expire, so just 2.5 years after that you have to come within 6 months prior to the expiry of the provisional registration, or within 6 months of the commencement of activity, whichever is earlier. The second point is not of much use. Most of the cases, first point is only relevant. The second point is mostly redundant only. Then, so your provisional registration will expire after 3 years. So you have to make an application after 2.5 years. Okay. Then within 6 months from the end of the now quarter. Now pay attention. Now everywhere quarter is written, not month. Here it was month. Here it was month. But year onwards, everywhere it is quarter. See, they have amended last year in 2024. So within 6 months from the end of the quarter, you will get a registration. Then you will get the benefit for 5 years, 5 years with inquiry. They will do inquiry and then they will give you benefit for 5 years, or another 5 years, or 3 plus 2. It is 3 plus 2. It is not another 5 years. It is 3 plus 2. It means 3 years provisional registration, another 2 years final registration you will get. I hope it is clear to all of you. It is not another 5 years. 3 years plus 2 years more. Then, a trust which is already registered, they will get exemption for how many years? Registration for 5 years. So after 5 years, they have to again come for re-registration. So now you are not going to get registration for lifetime. Before 2021, what used to happen? The government used to give registration for lifetime. Now maximum 5 years. So if you are already registered, you have to come again after 4.5 years, 6 months prior to expiry of registration. Then they will give you same within 6 months from the end of the quarter, and then it will be applicable for 5 years with inquiry. Then a trust which has become inoperative due to 11.7. Sir, what do you mean by this? 11.7, you can see over here 11.7. You don't want to claim 1023C, you want to come back to 12AB. So now, if you don't want to claim, I told you cannot claim 1023C and 12AB together, that both of them together is not possible. So now you don't want to claim 1023C, you want to claim 12AB. So you can come within 6 months prior to the AY from which the registration is sought. So when in whichever year you want to claim 12AB, right now I am claiming 1023C, I want to claim 12AB. So whichever year you want to claim 12AB, you come 6 months prior to that. I want to claim 12AB from 25-26. So you have to come by 30th September 2024. Then within 6 months from the end of the quarter, we will give you registration, and we will give you registration for 5 years with inquiry. And last but not least, if your trust is adopting a new object or modifying the existing object, your objects of the trust are changing or new objects are adopted, then also you have to make a fresh application within 30 days from the change. Then within 6 months, you will get, from the end of the quarter, you will get a fresh registration. And that registration will be applicable for 5 years. I hope it is clear to all of you. So change in object or addition in the object or deletion in the object also needs to make a separate application. You cannot continue with the old application. I hope it is clear. Now, some very important issues. Let me tell you. Some important amendments have been made in this year. For some people, see, if you see the registration period, in most of the cases, it is 5 years. But for some people, in fact, for most of the people, in some cases, the registration has been, the period has been increased to 10 years, subject to some condition. I am not saying the 5 year has become 10 year for everybody. No. 5 year has become 10 year for some people in some conditions. Who are those some people? First of all, let me tell you for whom 5 year is not applicable. 5 year is not applicable for 2 people. Let me tell you, let me put a cross in front of them. A new trust cannot claim, a new trust cannot claim 10 years exemption. 10 years is not applicable for a new trust. Similarly, this new trust also cannot claim 10 years. And any trust, any new trust which is coming for application for the first time, whether it has commenced the activity or not commenced the activity, doesn't matter. I am coming for application for the first time and I have already commenced activity. Still, you cannot claim 10 years benefit. I have not commenced the activity. I have not commenced the activity. Still, you cannot claim the benefit for 10 years. 10 years is not allowed for these 2 people. For all other people, 10 years is applicable. 10 years is applicable for this. See on the board, is applicable for this, is applicable for this, applicable for this, applicable for this. But not for new trust who is making application for the first time. For whom the government has increased the period to 10 years. They have understand that it is a compliance burden to come every 5 years. Therefore, they have increased the period to 10 years. For whom? Which are those fortunate people? The fortunate people are as follows. First, they have to fulfill 2 conditions. They have a trust which is registered under 12A subsection 1, clause AC, subclause 1, 2, 3, 4, 5. It means everybody except first time applicants. First time applicants are not covered here. Whether you have commenced the activity or not doesn't matter. So if your trust is making an application for the first time, don't come here. For you, maximum 5 years. Other than that, it can go up to 10 years if they fulfill one more condition. That is, their total income without giving exemption. Their total income without giving the exemption of section 1112 does not exceed 5 crore during each of the 2 preceding the year in which the application is made. Suppose the application is made in 25-26. So in 24-25 and in 23-24, in both the years, the total income before exemption should be up to 5 crores. So if the applicant's last 2 years total income is up to 5 crore before exemption, then the applicant can make an application and ask for 10 years registration directly. I hope it is clear to all of you. This is a very important amendment. It can come in the examination. Be careful. Now, next one. Sir, I have to make an application up to a particular date. Yes, you can see the dates over there. Sir, if there is a genuine reason, can the delay be condoned? Yes, the delay can be condoned by commissioner. Check, please. The commissioner can condone the delay if there is a reasonable cause. Why not? Definitely. That power has been given to the commissioner. Okay. Now, coming to one small issue, merger of regime 1 with regime 2. Sir, what is this now? As I've told you at the beginning of the discussion of today's session, that from 1st October 2024, the regime 1 and regime 2 are getting merged. Sir, what do you mean by regime 1 and regime 2 are getting merged, sir? I have told you that 1023C, etc. regime 1 is going to be discontinued from 1st October 2024. What do you mean by this? It means the following things. If any person is making an application, for regime 1 on or after 1st October 2024, that will not be considered. After regime 1, after 1st October 2024, everybody has to make an application under regime 2 only. 12AA, 12AB. You cannot make an application under 1023C after 1st October 2024. After 1st October 2024, the doors of applications are closed. Sir, what if I made application before 24? If you have made application before 24, then you will be granted registration under the first regime only. So all those who have made application till 30th September, you will be granted registration under regime 1 only, 1023C only. So will I continue to get the benefits? Yes, you will continue to get the benefits till the validity is approved. Approval is valid. Suppose approval is valid for 5 years, so 5 years you can claim 1023C. After that you have to come under 12A only. After that you have to come and get registered yourself under 12AB only. Make application under 12A and get registered under 12AB. There is no other option available after that. After that you have to come under 12A and 12AB. I hope it is clear to all of you. So from 1st October, regime 1 doors are closed for application. Application cannot be made. All those who have already made an application, they will get the registration under regime 1 only. Okay, and they can continue their registration under regime 1 up to the validity. Once the validity is expired, then come under regime 2. That's it. Now, let's talk about cancellation of registration. The provision of cancellation of registration are given under 12AB. Who has the power to cancel registration, sir? It is the Commissioner of Income Tax, Principal Commissioner, etc. They have the power to cancel registration. Let's talk about cancellation now. In what circumstances cancellation can happen? It can happen if the commissioner or principal commissioner has noticed any specified violation. Sir, what do you mean by specified violation? That I will see in a while now. Second, if they have received any reference from the assessing officer under second provision to 143 subsection 3. Do you remember? While doing the assessment under 143 subsection 3, the AO will check the assessee, that the AO will check the trust, whether the trust has done any specified violation. If the trust has done any specified violation in the opinion of the assessing officer, the AO will intimate the commissioner, then the commissioner will cancel the registration and intimate the AO, and then the AO will pass the assessment order. Do you remember that process? That process this is what it is talking about. So in first case, the commissioner suo moto observes the violation. In second case, the AO tells the commissioner. In third case, the case has been selected in the risk management strategy of the board, like it has been selected in SFT, AIS. There the government has come to know, there the department has come to know that the assessee has done some violation. Risk management strategy is nothing but the various risk management strategies like AIS, SFT, TIS, which is formed by CBDT, through which they get the information of tax evasion and tax avoidance. Now, once all these things are done, if the CIT finds any violation, specified violation, then he will call for the documents, he will make inquiry, he will give an opportunity of being heard, and if he is satisfied that you have done any specified violation, then he will cancel your registration, and if he is satisfied that you have not done any specified violation, then he will refuse to cancel the registration, then he will not cancel the registration. So both the possibilities are there. He will give you an opportunity of being heard, and then he will cancel the registration, or he will not cancel the registration, as the case may be. Then he will forward the copy of the above order to assessing officer and also to the trust, that is to the assessee. Now, what do you mean by the term specified violation? These 6 to 7 points are called as specified violation. First, where the CIT finds that the trust is doing any activity, the trust is applying the income for the objects other than the objects of the trust. If the trust is applying the income of the trust for the objects other than the objects of the trust, then it can be called as specified violation. Second, if the trust is doing PGBP, which is not incidental to the objective, and they are not maintaining separate books of account, they should do PGBP. Tata does PGBP. Tata does business, and also Tata has Tata Cancer Hospital, but they have separate books of accounts. So if the PGBP is done, and if there is no separate books of accounts, there is no separate accounting, there is no separate record, then it will be considered as a specified violation. Third, if the trust has applied this income for any private religious purpose, Fourth, if the trust has applied the income for any religious community or caste, not for the general public at large, but it is only caste driven, community driven, not allowed. It will be considered as specified violation. The point number E is very dangerous, where the commissioner is of the opinion that the activity of the trust is not genuine or it has not been carried out in accordance with the objects of the trust. It's a very dangerous line. Activity is not genuine. Activity is not in accordance with the objects of the trust. Or the trust has not complied with other laws. The trust has not complied with other laws. The trust is violating some other law, like the trust is violating Foreign Contribution Act and taking donation from unknown people, not disclosing the source. And the trust is not complying with the order or the decree or the directions of the court. So you should not violate other laws or the direction of the court or decree or order of the courts. Or last but not least, where the trust, just a second, what has happened? The trust has given an application under 12A which contains false or incorrect information. So when you made an application under 12A, at that time you have given a false information in the application, or that time you have given an incorrect information in the application, that can also lead to cancellation of registration. But if you have given incomplete information in the application, that cannot lead to cancellation of registration. See, giving incomplete information is different and giving false and incorrect information is different. So if the information column is empty, and then you have given the registration and then later on the department realized that, see, this column was empty, that cannot be the reason for cancellation of registration. Earlier, because of empty column also, the registration was getting cancelled, but now empty column cannot lead to cancellation of registration. I hope it is clear to all of you. Now, all these things will be done. All this cancellation of registration will be done by passing an order, and that will be passed within 6 months from the end of the quarter in which the first notice is issued by the principal commissioner or commissioner. Whenever the first notice will be issued by the commissioner or principal commissioner, from 6 months from the end of that quarter, the commissioner will pass the order. I hope it is clear to all of you. Now let's talk about exemption for capital gains in case of trust. When a trust can claim exemptions in case of capital gains? Very simple. Let's take an example. The full value of consideration of the asset is 9,30,000. Expense on transfer is 30,000. Net consideration 9 lakh. Cost of acquisition of the asset is 6 lakh and capital gains is 3 lakh. Now, if the trust wants to exempt this 3 lakh rupees, the law says very simple that you have to invest the full net consideration. If you invest the full net consideration, we will exempt full 3 lakh rupees. But if you invest less than 9 lakh rupees, then we will only exempt proportionate amount. How much proportionate amount? If you invest 9 lakh, then full 3 lakh is exempt. But if you invest only 8 lakh, then the exemption will be cost of new asset. The cost of new asset is 8 lakh minus cost of old asset. The cost of old asset is 6 lakh. Therefore, 2 lakh will be exempt and 1 lakh will be taxable out of it. Okay, I hope it is clear to all of you. It is not similar to 54F. Be very careful. 54F used to compute by multiplying something and dividing something. Here it is not like that. Here it is very simple. Whatever amount is received in the form of net consideration, reinvest fully, then full amount will be exempt. If you reinvest less than 9 lakh rupees, then cost of new asset minus cost of old asset will be exempt and the remaining amount will be taxable. Sir, what if I reinvest more than 9 lakh? Suppose if I invest 11 lakh, then obviously if you invest more than 9 lakh, then entire 3 lakh capital gains will be exempt and the excess 2 lakh will be considered as an application also. Excess 2 lakh you can claim as an application and you can reduce from the income of the trust. I hope it is clear to all of you. Is it clear? Now let's move on to the next part, which is a very important part for your examination. Before that, just give me a break for 2 minutes. Okay. Now let's go ahead with the next section, that is section 13, 13.1 and 13.3, along with that 115BBI and 271 AAB. These are the multiple sections that we have to, and along with that 56 to 10 also. So all these things are related to each other one by one. I am explaining. What is section 13.1? Section 13.1 says that if you do these 4 activities, then you cannot claim exemption under section 11 and 12. 11 and 12 is gone from your hand. Okay. Along with that, in some cases, the registration can also be cancelled along with 12AB. Okay. So if you do any of the 4 things, 11 and 12 is gone. Along with that, the registration can also be cancelled under 12AB. Now, what are these things? First of all, if you apply your income for private religious purpose, you cannot claim exemption under section 11 and 12. 11 and 12 is gone from your hand. Okay. Second one, and along with that, the registration can also be gone, because the cancellation of registration is also one of the reason over here. You can check it over here. If you apply the income, point number C, for any private religious purpose. Second, if you apply the income for any religious community, then also your what? Your registration will also be cancelled, and your exemption under section 11 and 12 will also be cancelled. Now the third one is very important. If you apply the income of the trust for certain specified person under section 13.3, so if you apply the income for certain specified person, then also your exemption will be gone. On that much amount, exemption will not be allowed to you. We are not saying that your full exemption will be gone. Suppose your income is 10 crore rupees. You are applying 1 crore for specified person, then you cannot claim exemption for that 1 crore. Remaining 9 crore, you can definitely claim the exemption. Now the question is, who are specified person? Let's come to the definition of specified person on the next page. Very important. There are some significant amendments over here in the definition of specified person. 100% some question might come from this in your examination. Be very careful. Okay. So what is specified person? Specified person includes the following things. The author of the trust is a specified person. The founder of the trust or institution is also a specified person. Okay. There is no amendment over here. Point number B. Here there is an amendment. Earlier, a substantial contributor was a specified person, and the definition of specified person, a substantial contributor earlier was any person who has contributed to the trust more than 50,000 rupees in the financial year is a substantial contributor. Now they have removed that limit of 50,000, and now they have put 2 limits. That is, in the financial year, if anybody gives you the donation of more than 1 lakh rupees, if more than 1 lakh donation is given in the entire financial year, or total donation given till date, from day 1, from last 10 years, 20 years till date, if the total donation given till the end of the current financial year is up to 10 lakhs. So you have to check 2 conditions for substantial contributor. In the current year, for current year, what is the limit? The entire year donation should exceed 1 lakh, and the aggregate donation given from year 1 till today, till the end of current year, should exceed 10 lakh rupees. Either of the conditions are fulfilled, you will be called as substantial contributor. Next, where the author or founder is an HUF. If the author and the founder is HUF, HUF can also be a founder and author, then the member of HUF can also be called as specified person. You cannot apply the money for the members of a HUF also. Then the trustee of the trust or the manager of the institution can also be called as what? Specified person. Then the relative of the author, founder, not relative of substantial contributors. Relative of substantial contributors are not considered to be what? Are not considered to be what? Are not considered to be specified person for the purpose of this section. So relative of whom are covered? Relative of author is covered, which is covered in point number A. Relative of founder is covered, which is covered in point number A. Relative of member and trustee is covered, which is covered in point number C and point number CC. So relative of point number A is covered, relative of point number C is covered, relative of point number CC is covered. Relative of point number B is not covered in the definition of specified person. Be very careful. Okay. Next, any concern in which any of the other person other than the substantial contributor, again point number B is not covered. So there is a company in which the author, the founder, the trustee, the manager, the member of the HUF, all these people have what? Substantial interest. Then that concern will also be called as what? As a specified person. That concern will also be called as specified person. Okay, for the purpose of this section. Substantial interest means in any entity, if you hold 20% at any time during the previous year, that will be called as substantial interest. And for the purpose of this section, relative means as defined under IFOS in gift taxation, which the definition of the gift taxation relative is very wider as compared to normal relative. The term relative is defined under section 241, but that is a general definition for the entire income tax law. That's a very small definition. The definition covered in section 2 clause 41 is a very small definition, but the definition covered in IFOS in gift taxation, that is a very wider definition, very wider. That wider definition has to be applied here, not the narrow definition. I hope it is clear to all of you. Okay, now coming to this discussion, all of you, coming to this specified person discussion, I will come to this discussion again. Last but not least, if you invest in the mode other than 11.5, then also it will be your exemption under section 11 and 12 will be gone. You cannot invest in the mode what? Other than 11.5. I hope it is clear to all of you. Just a second. Pen is not working. Just a second. Now coming to some technical issues now. Again, I am saying 13.1 says what? If you apply your income for any private religious purpose, if you apply your income for any particular community, if you apply the money income for any specified person, or if you apply the income for other than, if you invest your income other than 11.5 modes. In all these 4 cases, you will not get exemption under section 11 and 12. Now, coming back to this third point once again, when you apply the money for specified person. So when I apply the money for specified person, all these people, what is the consequence number 1? The consequence number 1, I will not get exemption under 11 and 12. So suppose my total income is 10 lakh rupees. Out of that, I have applied 3 lakh rupees for specified person. So I will not get exemption. 3 lakh rupees I have applied for specified person. So on that 3 lakh rupees, I will not get exemption under 11 and 12. Okay. Whatever application I have done, that will not be considered as an application. Plus, the recipient of the gift, will be liable for gift taxation under 56.210. The recipient will also be liable for gift taxation under 56.210 of 2 lakh rupees. Plus, the giver, that is the trust, will be liable for penalty under 271 AAE for passing on unreasonable benefit. How much penalty? First time 100% of the amount applied. Second time 200% of the amount applied. Fourth, whatever amount I have applied on the trust, on the specified person, that will be taxable flat 30% under 115 BBI. Multiple consequences are there. 4 consequences. 3 in the hand of trust, 1 in the hands of recipient. First, the trust will not get exemption for that 3 lakh rupees, which is unreasonable benefit to the to whom? To the specified person. Second, the recipient will be liable to tax. Third, the trust will be liable for penalty. First time 100%, second time subsequent time 200%, and the fourth, the trust will be liable for 30% tax on that particular amount which is applied unreasonable. Dangerous consequences. Be very careful with this. Very dangerous consequence. Coming back to the discussion. Now there is one technical issue. Suppose I am at hospital and there is an hospital and I am the trustee of that hospital. So in that hospital I will not go because the law says that you cannot give benefit to the trustee. Or my children cannot go because the law says that you cannot give the benefit to the relatives of the trustee. So what example I will set in life? My hospital is there, I am the trustee and I am myself not getting admitted in that hospital and I am not getting my children also admitted in that hospital because the income tax law stops me. There is nothing like that. For hospital and education purpose, there is a relaxation. So if there is an hospital, medical facility and educational purpose, you can provide facility to such a specified person. But if you provide for free of cost or if you provide at concessional rate, then it will be deemed to be income of the trust. Registration will not be cancelled, don't worry. So suppose there is an hospital, I am the trustee and my children are not well. So I am admitting them in the hospital and I am charging 5 lakh to others. I am charging 5 lakh to myself also. Then there is no violation. But if I am charging 5 lakhs to others, but I am charging only 2 lakhs to my children, then 3 lakhs will be deemed to be income of the trust. Plus that 3 lakh rupees which I am applying, with the hospital is applying on the children of the trust, that will not be allowed as an exemption also. There are 2 consequences you have to bear. That 3 lakh extra benefit will not be considered to be as an application for the trust and that will be added as a deemed income of the trust. I hope it is clear to all of you. Now coming to 115 BBI. What are the circumstances in 115 BBI is applicable? First one I will say at the end. Second one I will say. Second one, 115 BBI, first of all, the consequence is flat 30% tax plus surcharge if applicable and cess without deduction of any expenses and allowances. No deduction of any expense, allowances or set off of losses will be allowed. The second point I am saying first, if you accumulate the money in 11.2 and if you misuse in 11.3, the 4 circumstances which I have told you in 11.3, then deemed income I have already interlinked with 11.3 earlier. You withdraw the money and apply for other purpose. You withdraw the money and give donation. You don't withdraw the money within 5 years. You withdraw the money and apply and invest in other than 11.5 modes. All these 4 cases were covered in 11.3. In all these cases, your income will be chargeable at flat 30% tax. Next, you apply the income for certain specified person as mentioned earlier, as I have told you. Next, if you do not deposit your money in the mode specified in 11.5, if you invest other than 11.5, then it will be deemed income. Next, if you use the money outside India, as I've told you earlier, you have to use the money of the trust in India only. You cannot use outside India. If you use the money outside India, that amount will be considered to be deemed income under section 115 BBI. It will be taxable under 115 BBI. Now coming to point number 1. Suppose 100 rupees is your income, 15% is flat exempt. What should you do with 85 rupees? 85 rupees you should apply for the objects of the trust. Now you are applying 85 rupees for other than objects of the trust. That 85 rupees will also be subject to tax at 30%. So that 85 rupees should be applied for the objects of the trust. Such accumulation is not allowed under any specific provision. If you apply that 85 rupees for other than objects of the trust, that 85 rupees will also be subject to 30% tax. I hope it is clear to all of you. So this is what the interlinking of section 13, section 13.3, 271 AB, 56.210 and 115 BBI is all about. I hope it is clear to all of you. Now a small issue is there. I will address that and then I will go ahead with the next part. Do you remember that in the definition of charitable trust under section 2 clause 15 there was a 7th point, that is the proviso to section 215, any other object of general public utility, if the commercial receipt is up to 20% of total receipt, you can claim exemption. Now in that case what will happen? Suppose my commercial receipt exceeds 20% of total receipts. So what will happen? You will not get exemption. Exemption will not be allowed to you. So now the question is, exemption will be denied to me. Whether the registration will also be cancelled? No. Section 13.8 says that in such cases only exemption will be denied, registration will not be cancelled. Only registration will continue to remain, but the exemption will be denied in the current year. Okay, I hope it is clear to all of you. Now there was an issue which was there around 3-4 years back in 2021-22. So the CBDT came up with this provision. There are 3 mistakes which the trust is doing. First, the trust commercial receipt is exceeding 20% of total receipt. Mistake number 1 I am highlighting. Second, the trust is not getting books of accounts audited. Mistake number 2. And the trust is not filing the return. Mistake number 3. So if any of the 3 mistakes trust is doing, commercial receipt exceeding 20%, not getting audited, not filing the return, then how the income of the trust will be chargeable? So for that the government has given a special mechanism. How, sir? What is the special mechanism? Check please. In that case, the trust will get all deduction except capital expenditure. Capital expenditure will not be allowed to you. Okay. Secondly, if an expenditure is not from corpus standing as on the last of year, such expenditure is not from the corpus of the suppose current year is previous year 25-26. So the expenditure in the current year should not be done from the corpus which is standing on 1st April 2025. So whatever corpus is of the last year, 24, 25, 23, 21, from that you should not do expenditure. You should do expenditure from the current year income only. You cannot do expenditure from last year income. Second disadvantage. Third, expenditure is not from any loan or borrowing. You should do expenditure from your pocket. You cannot take a loan and do expenditure. If you take a loan and do an expenditure, it will not be allowed. Then depreciation is not allowed if you have already claimed the asset as an acquisition of an asset as an application. Suppose in earlier you have already claimed application of an asset as an application, purchase of an asset as an application, then depreciation will not be allowed on that asset. Next, you cannot give donation. Donation cannot be allowed as a deduction. Even voluntary donation will not be allowed to you. Now all these restrictions are for whom? Who do not do audit, who do not file return, or whose commercial receipt exceeds 20% of total receipts. Further, TDS has to be deducted. If not deducted, then 40A1A will attract, 30% expenditure will be disallowed. And if you make a payment of more than 10,000 rupees to a person in a day, you have to make the payment by 4 modes. Otherwise, the expenditure will be disallowed. And the set-off of losses of earlier year will not be allowed. Excess application will not be allowed as a deduction to you. I hope it is clear to all of you. Check it, please. Is it clear? Excess application not allowed. So what are the disadvantages over here? Disadvantage number 1, capital expenditure not allowed. Disadvantage number 2, corpus, if you incur the expenditure in the current year from last year corpus, that will not be allowed. If you take a loan and incur, not allowed. If you have already purchased an asset and consider as an asset as an application, then depreciation won't be allowed. Then your donation will not be allowed. Even voluntary donation will not be allowed. Then TDS has to be deducted. More than 10,000 rupees has to be by online modes, and excess application of last year cannot be claimed as reduction. I hope it is clear to all of you. Now coming to 115 BBC, which we have left earlier. So what is 115 BBC? Anonymous donation. What is the treatment of anonymous donation? Anonymous donation is taxable at 30% flat under 115 BBC, subject to only one exemption. No other exemption is allowed from anonymous donation except one exemption. Sir, what is that one exemption which is allowed for anonymous donation? That I am saying today. Only one exemption is allowed for anonymous donation. What is that, sir? Pay attention, please. Suppose the anonymous donation is 10 lakhs and other donation is 90 lakhs. So I am writing anonymous donation 10 lakh. How much is exempt? Only one. 5% of total donation or 1 lakh, whichever is higher, that's it. Nothing else will be allowed. So out of total donation, 5% of total donation, 5% of 100 lakhs will come to how much? 5 lakhs. So from 10 lakhs, 5 lakhs will be exempt, 5 lakhs will be taxable at flat 30% plus surcharge and cess if applicable. Now, this 10 lakh rupees will not be allowed as exemption under section 11. Even if you apply for the objects of the trust, this will not be allowed as an exemption. This cannot be allowed as an exemption. Okay, I hope it is clear to all of you. Now, what about this 5 lakh rupees, sir, which is exempting? For that, the law is giving two treatment, which one I have mentioned over here, one I have not mentioned. You can do both in the examination. While solving the sum, I have done both. For this 5 lakh rupees, you have two options. First option, very simple. Add this 5 lakh rupees at the end of the statement. After all application, after 15% and after all application, add this to the end of the statement and apply slab rates. Second, add this to the normal income statement before 15%, claim 15%, and then apply that this 5 lakh also for the objects of the trust, and then the remaining amount will be subject to slab rates. So both the things you can do, I have written over here in point number 2. What are the two things you can do for this 5 lakhs? See, segregate this 10 lakh into two parts. This 5 lakhs, which is post exemption, that is by default taxable at 30%. There is no exemption possible on this. But this 5 lakhs, you can claim exemption on that. Add to the income statement, reduce 15%, apply for the objects of the trust. Option 1. Second option, easier option, add to the end of the income statement. No need to claim 15%, no need to claim any exemption. I hope it is clear to all of you. Both the opinions ICAI has given, which I have solved in the sum also in the question. I think so it was question number 13 of our question bank. Go and check. I have written in the bracket also, must do question. Now, for some people, anonymous donation section is not applicable. Who are those fortunate people? If you are wholly religious, anonymous donation section is not applicable. Sir, what do you mean by not applicable? Not applicable means exempt. No. Not applicable does not mean exempt. Anonymous donation not applicable means it will be treated like a voluntary donation. Add to the income statement, claim 15% and apply. I am not saying it is exempt. So, if it is a wholly religious trust, anonymous donation section is not applicable. 30% will not be applicable. Sir, what if it is wholly charitable? If it is wholly charitable, then it is applicable. Sir, what if it is partly charitable and partly religious? School is also there and church is also there. Then what will happen? Then you have to maintain two donation box. The money received, the donation received in the church will be exempt. The donation received in the school will be subject to 115 BBC. And the donation received in the church will not be exempt, sorry, will be subject to normal taxability. Two separate donation boxes have to be made. Check it, please. I hope it is clear to all of you. And if it is wholly charitable, then it is definitely taxable. There is no doubt about it. Now, some additional provisions are there. One by one, we will see. Now, let's talk about regime 1 little bit, 1023. See, in regime 1, all the trusts are categorized into 3 trusts. First, 1023C, 2AB, 3AB and 3AC. Which are these trusts? These are institutions like university, college, institutions, hospitals, which are substantially financed by government. How will we come to know that the institution is substantially financed by government? If the government grant is more than 50% of the total receipts. If the government grant is more than 50% of the total receipt, you can say that the trust is substantially financed by the government and therefore they are exempt. They are exempt. So, if the total receipts of the trust is say 100 crore and the government has financed 60 crore, government has given grant of 60 crore, then it is substantially financed by the government. Close your eyes and claim exemption. Second, if you are a university, educational institution or hospital, and if your aggregate receipt do not exceed 5 crore, then it is exempt. No need to take any approval also. No need to write down over here. In this point number 2, no need to take any approval if your aggregate receipts from both. 5 crore limit is not applicable separately for school and hospital separately. For if you have one school and one hospital, take the aggregate receipts of both of them, it should be up to 5 crore. If the aggregate receipt is up to 5 crore, no need to claim any exemption. No need to make any approval. No need to make any application to commissioner or anybody. Directly claim exemption. But yes, so in point number who comes? Point number substantially financed government. In point number 2, small institutions. Apart from that, point number 3 covers rest of them. If you are not a small institution, your receipts are more than 5 crore and you are not substantially financed by the government, then you will come in point number 3. In that case, you have to make an application to the commissioner and take the registration, etc. The entire due process you have to fulfill. So point number 1 covers substantially financed entity. Point number 2 covers small trust, small institution. Point number 3 covers the rest of 2, other than 2. Okay. Now, next, some small points are there. We will discuss that. Then we will go to exit tax. Now, books of accounts and audit. Yes, if the total income of the trust exceeds the basic exemption limit, Which total income? Before giving exemption. Before giving exemption, if your income is greater than basic exemption limit, you have to maintain books of accounts and conduct audit also. So what is the basic exemption limit? Under new regime, it is 4 lakh. Under the old regime, it is 2.5 lakh. If it exceeds, if your income before giving exemption exceeds the basic exemption limit, you have to maintain books of accounts, you have to conduct audit. Now, next one, I will say first and then I will come back to the previous one. Filing of return. Yes, if you want to claim exemption, you have to file the return. You can file the return within the time allowed under 139(1) or 139(4), but you cannot file a return under 139(8)(a). You cannot file an updated return and claim exemption under 11 and 12. Exemption under 11 and 12 is not possible under updated return. That is not possible. I hope it is clear to all of you. Now, one option is given to religious places if they conduct renovation of their religious places. Suppose I am a temple or a mosque or a gurudwara or a church, etc. So if I want to renovate my gurudwara, church, mosque, temple, etc., and if I am taking some voluntary contribution from people, then I can treat that voluntary contribution as a corpus donation. I have an option to treat that as a corpus donation and fulfill some condition and exempt that donation. What are that conditions? So whenever I am a temple, mosque, gurudwara, church, or any other place of notified under ATG, if I receive voluntary contribution, at an option I can treat that as a corpus. By default, it is voluntary contribution, but at an option, I can treat that as a corpus. But I have to fulfill the following 4 conditions. First, I will apply such corpus only for repair and renovation of the religious places, not for other purpose. I will not give that as a donation to any other person. Plus, I will keep that as a separately identifiable. Separately identified, it has to be identified separately. Then, I will invest that in the mode specified in 11.5. I will invest that in the mode specified in 11.5. In 11.5, I will invest that. I hope it is clear to all of you. If any of the conditions are violated, then it will be treated as deemed to be the income of the trust in which the violation takes place. So if I fulfill these 4 conditions, I can treat my voluntary donation as what? As a corpus donation, or else I have to pay tax on it. I hope it is clear to all of you. Now, what is 11.5? 11.5 is certain specified modes. What does it cover? Mainly it covers government securities. You don't have to buy hard this, but just go through it once. Let's see that once. Investment in government savings certificates, units of UTI, central government or state government security, debentures of any company which is guaranteed by government, mutual fund units, equity shares of depositories, stock certificates as defined in Sovereign Gold Bond Scheme 2015, shares of NSDC, shares of stock exchange, subsidiaries of stock exchange, deposit with post office saving banks, scheduled banks, cooperative banks, industrial development bank, then investment or deposit in any public sector company. If your investment means shares, and deposit means a kind of dead. If the public sector company, this is very important point, ceases to be in public sector company, then the investment in shares of that company should be treated as legitimate till 3 years from the date of cessation. So, today you have invested in the public sector company. Now, next year, the company ceases to be public sector company, they have sold to private player. Then for 3 years, it will be considered to be a public sector company, don't worry. And for deposit, don't worry, it will be considered as valid till the maturity. So, today I purchased the investment, I purchased the shares of Air India. Air India's public sector company, for example, today. And today I purchased the deposits of Air India. Now, next year, Air India has become what? Has been sold to private players. It has been sold to Tata. So, for 3 years, I don't have to worry for shares, and for deposit, I don't have to worry till maturity. Okay? It will be considered to be a valid investment. Investment in bond of approved financial corporation, public companies providing long-term finance, investment in immovable property, and last is very recently added in 2025, units of power grid investment infrastructure trust. Units of power grid infrastructure investment trust. This has been very recently inserted in last year in 2025. Okay. Now let's move on to the exit tax. Now what is exit tax, sir? What is exit tax? Exit tax or accredited income tax is nothing but when a trust ceases to be working like a trust. If a trust does any of the 3 activities, they will be liable for exit tax. Sir, which are the 3 activities that the trust should not do? So, if the trust is doing any of the 3 activities, they will be liable for exit tax. Sir, tell the 3 activities. First activity, I am a charitable trust, I am a religious trust, and I am doing an activity which is not within the objects of my trust. I am doing an activity which is not covered in the objectives of the trust, and I am not doing the activity which is charitable and religious. So, if you ceases to do the activities of charitable and religious trust, you will be liable for exit tax. Second, I am a charitable and religious trust and I am getting merged with another entity which is not doing activities similar to 12AB. So I am doing a merger with an entity which is a business entity, not doing charitable activity. Then also I will be liable for exit tax. Third one, if my trust is dissolved and within 12 months, if my trust is dissolved and within 12 months, if I don't transfer all my asset and liabilities, if I don't transfer my asset and liabilities to another trust registered under 12AB, then I will be liable for exit tax. So three people are liable for exit tax. First, who ceases to be a trust. Second, who merges with another entity, which is a business entity, not a charitable entity. And third one, who is absolutely dissolved and not transferring the assets and liabilities to another charitable trust registered under 12AB or 1023C within 12 months. In these three cases, you will be liable for exit tax. How much exit tax? MMR, 34.944% tax on your accredited income. Sir, what is accredited income? Accredited income is nothing but aggregate FMV of all assets of the trust minus aggregate total liabilities. Sir, how to compute this? That we will see as per Rule 17CB. Rule 17CB talks about how to compute aggregate FMV of all assets and aggregate FMV of all liabilities. But before that, three things you will never take in total assets and liabilities. Three things you will never take. If you have acquired any assets from agriculture income, then you will never take in the asset and liability. Any asset acquired from agriculture income, then that will not be form part of what? That will not be form part of accredited income. Second, any asset, which is any asset and liability also, which is purchased or which is incurred before the date of registration. Suppose the trust was created in 2015 and the registration happened in 2020 and the exit tax is applicable in 2025. So all the assets which are purchased and all the liabilities which are incurred from 2015 to 20, that shall not form part of what? Exit tax. Exit tax. It shall not form part of exit tax. And third, in case of dissolution, if the assets and liabilities of the trust has been transferred to another trust, another charitable trust within 12 months, that should also not be part of what? Exit tax. So any asset purchased from agriculture income will not be form of part of trust, will not be part of exit tax. Any asset purchased, any liability incurred before the registration of the trust, it means only assets and liabilities which are incurred after the registration should be part of exit tax. Anything which is purchased and incurred before the registration should not be part of exit tax, and any asset and liabilities which is transferred to another trust in case of dissolution within 12 months, that shall also not part of exit tax. Next, no deduction will be allowed from this particular exit tax income. In case of payment failure, you have to pay interest at the rate of 14%. You have to pay the tax within 14 days from the date of what? Ceasing to be a trust. Whenever you cease to be a trust or whenever you dissolve your trust, within 14 days you have to pay the tax. I hope it is clear to all of you. Later on, whenever you will sell the asset, whatever is the FMV you have taken in this chapter, that will become the cost of acquisition for future. And the tax rate over here is MMR. MMR is generally 30% plus 37% plus 4%. But for the purpose of this section, the MMR is different. Only for the purpose of this section, the MMR is 30 plus 12 plus 4. Here it is not 37% surcharge. Here it is always 12% surcharge. Be careful. But for other chapters, it can be 37% surcharge. I hope it is clear to all of you. Is it clear? I hope it is clear. Now let's talk about Rule 17CB. How actually the accredited income will be computed. As I have told you, accredited income is nothing but aggregate of all assets minus aggregate of all liability. So now, when I take aggregate FMV of all assets minus aggregate FMV of all asset liability, let's talk about one by one all of them. Aggregate FMV of all assets will come how? You take the FMV of all assets, but don't take two assets in the FMV. That is, don't take TDS, TCS, advance tax, and don't take fictitious assets. Don't take TDS, TCS, advance tax, and don't take fictitious assets. And in liability, I will talk about that in later. Now, assets. So you have to take all assets. Pay attention on the board, please, how to segregate all of them. You have to take all assets except these two assets. Now, in all assets are also categorized into multiple parts. First, let's talk about quoted shares and security. Quoted equity shares, quoted preference shares, quoted security, debentures, bonds, etc. You have to take average of the lowest and highest price on the recognized stock exchange on the specified date. Specified date means the date on which the trust ceases to be a trust. So, you have to take average of the lowest and the highest price on the recognized stock exchange. So, no trading on the specified date, then you have to take average on the preceding date. Okay, this is for quoted equity shares, quoted preference shares, and quoted bonds, debentures, everything. Now, let's talk about unquoted equity shares. Unquoted equity shares, same formula we have done earlier two times. Rule 11 UAE we have done. Do you remember that? Black money law also we have done this particular formula. Still, I will say once more. A plus B minus L. This is whose unquoted share. This is whose values, not our values. It is the value which you will get from the balance sheet of the company in which you have invested in the shares. Suppose I am a trust, I invested in ABC Private Limited Company. So these are the data I will take from ABC Private Limited Company to value my unquoted equity shares. A plus B minus L. A and B is asset, L is liability. PV stands for paid up value of one share, 10 rupees, 20 rupees, 30 rupees. And PE stands for total equity capital. That is 10 crore, 20 crore, 100 crore, 200 crore. So now what is A? A is book value of all assets, other than bullion, jewelry, precious stone, artistic work, share, security, immobile property. Again, when you take the A, don't take TDS, TCS, advance tax, don't take fictitious assets. These are whose TDS, TCS, advance tax, not ours. It is the TDS, TCS, advance tax of that private company. So in A, you will take book value of all assets. For all other assets, you will take FMV. For bullion, you will take FMV. For bullion, check here. For bullion, repeating FMV, jewelry FMV, precious stone FMV, artistic work FMV, shares, security FMV, immobile property also FMV as per this rule. For liability also same rule, same. All these things are copy paste. I am not repeating. It is exactly like rule 11 UAE, which I have said in the chapter of what? Chapter of slum sale. You can go and check. Now let's talk about the third asset. Valuation of shares and security other than equity shares. Which shares are covered? Quoted shares are already covered in point number 1. So who are covered over here? Here they are talking about unquoted preference shares. Okay. Or they are talking about unquoted debentures, unquoted bonds. Unquoted preference shares are not covered in point number 1. They are not covered in point number 2. What will you do? You will take market value. You will take market value as per merchant banker or accountant. Then you will take immobile property. Immobile property, don't take book value. Take market value or stamp duty value, whichever is higher. Take market value or stamp duty value, whichever is higher. Then you will take valuation of a business undertaking. If the trust has share in some share in some partnership firm or AOP BOI, then take A plus B minus L of that partnership firm and then multiply it by the share. Suppose the share is 30%. So take A plus B minus L of that particular partnership firm and then multiply by 30%. And last but not least, other assets. Other assets you will take what? Market value, not book value. So all the assets are categorized into how many assets? 6 assets. 6 category. First one, quoted shares and securities. Second, unquoted only equity shares. Third one, you can say unquoted preference shares and securities. Fourth one, you can say immobile property. Fifth one, business undertaking. Sixth one, other assets. Now, here we complete the assets. Now we will talk about how will you compute the liabilities, total liabilities. From aggregate FMV of all assets, you have to reduce your liabilities. Now, how will you reduce the liabilities now? Book value of all liabilities. Now, this is our liability. This is the liability of the trust. You will take book value of all liabilities. You will not take capital. You will not take accumulated fund. You will not take corpus. You will not take reserves and surplus. You will not take profit and loss account. You will not take uncertain liability. You will not take provision for tax. General liabilities you will take. Creditors you will take. Bank overdraft you will take. Outstanding expenses you will take. Loan you will take. Debentures you will take all these general liabilities which are there in the trust balance sheet. Again, you will not take the liabilities which are incurred before creation of the trust. Before registration of the trust, sorry. The trust was created in 2015. Registration happened in 2020. Trust dissolved in 2025. So you will not take the liabilities of from 2015 to 2020. Be very careful. Okay. Now, deemed exit tax. Now you know that you have to make an application for registration of trust under various cases. First of all, for existing trust, they have to make an application by 30th June 2024. All those who are trusts which are registered since 1961, they have to get themselves re-registered by what? By 30th June 2024. Then for provisional registration people, they have to come for registration after 2.5 years. Then for final registration people, they have to come for registration after 4.5 years. So there are a lot of time limits for making application for registration. Now, if you don't apply for the trust registration on time, you will be liable for deemed exit tax. So if you don't apply for the registration of the trust within time, you will be liable for deemed exit tax. A deemed exit tax provision will be applied on you and you will be liable to tax on that. I hope it is clear to all of you. And last but not least, 12AC, a small section is there which is applicable from 1st October 2024, which gives you some relaxation. That if an institution or trust is getting merged with another institution and trust, exit tax will not apply subject to some conditions. I am a trust, you are a trust. I am getting merged with you, not merged with a business entity. I am getting merged with another trust. Exit tax will not apply to me subject to some condition. First, the objects of the trust should be similar. My object and your object should be similar. Second, I should also be registered and you should also be registered. We both should be registered under 12AB or 1023C. Third, they should fulfill some prescribed condition that the law may prescribe. I don't know what are the prescribed conditions as of now. Whenever they will prescribe, I will let you know. So this is what the revision of your full the revision of your taxation of trust in full English along with taxation of exit tax in full English is all about. Okay, so I hope you all have enjoyed the revision video. Okay. Now please say What is your opinion? What is your opinion? Please say, how are you all? Are you all enjoying the revision videos? Tomorrow I will be doing transfer pricing. Okay. Bye, all of you. Take care. See you soon.